Introduction to commercial property portfolios. Building a portfolio of small commercial properties involves strategically acquiring and managing multiple income-generating real estate assets. This approach aims to diversify investment risk and enhance overall returns compared to owning a single large property. Small commercial properties typically include retail units, small office buildings, light industrial warehouses, and multi-tenant flex spaces. Understanding the fundamentals of portfolio construction is crucial for long-term success in commercial real estate investment. This course will guide you through each step, from initial market research to advanced portfolio optimization strategies. It emphasizes practical knowledge and actionable insights for aspiring and current investors. The goal is to create a resilient and profitable collection of assets. Defining small commercial properties. Small commercial properties are distinct from large institutional assets and residential properties, characterized by their manageable size and often local market focus. These properties typically range from single-tenant retail stores to multi-unit office buildings with a few tenants. They offer a lower entry barrier for investors compared to large-scale developments, making them attractive for portfolio building. Understanding the specific characteristics of these properties, such as typical tenant profiles and lease terms, is essential for effective investment decisions. They often serve local businesses and communities, providing stable income streams. Their smaller scale can also mean less complex management, though due diligence remains critical. Benefits of portfolio diversification. Diversifying a commercial property portfolio across different property types, locations, and tenant industries significantly mitigates risk. For instance, if one property type experiences a downturn, others may remain stable or even appreciate, balancing overall portfolio performance. This strategy reduces reliance on any single asset or market condition, providing a more resilient income stream. Diversification also allows investors to capitalize on varied market cycles and growth opportunities in different sectors. It is a cornerstone of sound investment principles, protecting capital and ensuring consistent returns. A well-diversified portfolio is better equipped to withstand economic fluctuations and unforeseen challenges. This approach fosters long-term stability and growth for the investor. Understanding market research fundamentals. Thorough market research is the bedrock of successful commercial property investment, providing critical insights into local economic conditions and property trends. It involves analyzing demographic shifts, employment rates, local business growth, and infrastructure developments. Understanding supply and demand dynamics for specific property types within a target area is paramount. This research helps identify undervalued assets, emerging growth areas, and potential risks. Effective market research allows investors to make informed decisions, avoiding speculative ventures, and focusing on sustainable opportunities. It is an ongoing process, requiring continuous monitoring of market indicators. This foundational step ensures that investment strategies are aligned with real-world conditions. Identifying target markets and niches. Identifying specific target markets and property niches is crucial for focusing investment efforts and maximizing returns. This involves pinpointing geographic areas with strong economic growth, favorable demographics, and a demand for particular commercial property types. Examples include suburban areas experiencing population growth, urban centers with revitalized districts, or industrial zones benefiting from logistical improvements. Within these markets, investors can specialize in niches like medical offices, quick service restaurants, or specialized workshops. Focusing on a niche allows for deeper market expertise and more efficient deal sourcing. This strategic targeting helps in building a cohesive and high-performing portfolio, It also streamlines the property acquisition and management processes. Understanding these specific segments provides a competitive edge. Financial analysis. Key metrics. Mastering key financial metrics is fundamental to evaluating the profitability and viability of potential commercial property investments. Essential metrics include capitalization rate, cap rate, cash-on-cash return, debt service coverage ratio, DSCR, and net operating income, NOI. The cap rate helps compare singular properties based on their income-generating ability, while cash-on-cash return measures the annual return on the actual cash invested. DSCR assesses a property's ability to cover its debt payments, indicating financial stability. NOI represents the property's income after operating expenses, but before debt service and taxes. Thoroughly understanding and calculating these metrics enables investors to make sound, data-driven decisions. These calculations provide a clear picture of a property's financial health. They are indispensable tools for any serious investor. Calculating return on investment, ROI. Calculating return on investment, ROI, is a critical step in assessing the profitability of a commercial property investment. ROI measures the gain or loss generated on an investment relative to the amount of money invested. It is typically expressed as a percentage, providing a clear indicator of investment efficiency. The basic formula involves dividing the net profit of an investment by its initial cost. For real estate, this includes factoring in rental income, property appreciation, and all associated expenses like maintenance and taxes. A higher ROI indicates a more attractive investment opportunity. Understanding how to accurately calculate ROI helps investors compare different properties and make informed decisions. This metric is vital for evaluating past performance and projecting future gains. It provides a standardized way to measure financial success. Sources of funding for acquisitions. Securing appropriate funding is a pivotal aspect of acquiring commercial properties, and various sources are available to investors. Traditional bank loans and commercial mortgages are common, offering structured financing options based on property value and investor creditworthiness. Small Business Administration, SBA loans, particularly SBA 504 loans, can provide favorable terms for owner-occupied commercial properties. Private lenders and hard money loans offer faster access to capital, but often come with higher interest rates and shorter terms. Additionally, crowdfunding platforms and real estate syndications allow investors to pool capital for larger acquisitions. Understanding the pros and cons of each funding source is crucial for selecting the most suitable option for your investment strategy. Each source has unique requirements and repayment structures. Careful consideration of these options is essential for successful property acquisition. Leveraging debt and equity effectively. Leveraging both debt and equity is a sophisticated strategy for maximizing returns and expanding a commercial property portfolio. Debt financing, typically through mortgages, allows investors to acquire properties with a smaller initial capital outlay, amplifying potential returns through positive leverage. However, it also introduces interest rate risk and repayment obligations. Equity, on the other hand, represents the investor's direct ownership stake and provides a cushion against market fluctuations. A balanced approach involves optimizing the debt-to-equity ratio to achieve desired risk-adjusted returns. Understanding how to strategically deploy both forms of capital is vital for sustainable portfolio growth. This balance can significantly impact cash flow and overall profitability. Prudent use of leverage is key to long-term success. Property acquisition strategies. Developing robust property acquisition strategies is essential for consistently adding valuable assets to a commercial portfolio. These strategies encompass various approaches, from direct purchases to more complex deal structures. Off-market deals, often sourced through networking and direct outreach, can provide opportunities to acquire properties below market value. Working with experienced commercial real estate brokers is another common method, leveraging their market knowledge and access to listings. Auctions and foreclosure sales can also present high-potential, albeit higher-risk, acquisition avenues. Understanding negotiation tactics and deal structuring, including options and seller financing, further enhances acquisition capabilities. Each strategy requires careful evaluation of its risks and rewards. A diversified acquisition approach can lead to a more robust portfolio. This proactive approach is key to finding the best deals. Due diligence process explained. The due diligence process is a critical investigative phase before finalizing a commercial property acquisition, designed to uncover any potential issues or liabilities. It involves a comprehensive review of financial records, lease agreements, property condition reports, environmental assessments, and legal documents. A thorough due diligence ensures that the investor fully understands the property's true value, operational costs, and any existing encumbrances. This process mitigates risks by identifying hidden problems that could impact profitability or lead to future legal disputes. Engaging professionals such as attorneys, accountants, and property inspectors is essential during this phase. Skipping or rushing due diligence can lead to significant financial losses and unforeseen complications. It is a non-negotiable step for prudent investment. This meticulous examination protects the investor's interests. Legal aspects of commercial real estate. Navigating the legal landscape of commercial real estate is paramount for protecting investments and ensuring compliance. This involves understanding various legal documents, regulations, and potential liabilities associated with property ownership. Key legal aspects include purchase agreements, lease contracts, zoning laws, environmental regulations, and property titles. Engaging an experienced real estate attorney is indispensable to review contracts, conduct title searches, and advise on compliance issues. Legal due diligence helps identify easements, liens, and other encumbrances that could affect property value or usage. Awareness of landlord-tenant laws and dispute resolution mechanisms is also crucial for effective property management. Proper legal counsel minimizes risks and ensures smooth transactions. It provides a secure foundation for the investment. Adherence to legal frameworks is non-negotiable. Negotiation tactics for property deals. Effective negotiation tactics are vital for securing favorable terms in commercial property deals, directly impacting profitability. This involves thorough preparation, understanding the seller's motivations, and clearly articulating your investment goals. Key tactics include presenting strong offers backed by solid financial analysis, being prepared to walk away if terms are unfavorable, and identifying win-win solutions. Building rapport with sellers and their agents can also facilitate smoother negotiations. It's crucial to negotiate not just on price, but also on contingencies, closing timelines, and other contractual terms. Mastering these skills can lead to significant savings and better overall deal structures. Patience and persistence are valuable attributes in this process. Successful negotiation ensures optimal outcomes for your portfolio. Property management essentials. Effective property management is crucial for maximizing the value and profitability of a commercial property portfolio. It encompasses a wide range of responsibilities, including tenant relations, lease administration, maintenance, and financial oversight. Proactive management ensures tenant satisfaction, minimizes vacancies, and maintains property condition, all of which contribute to stable income streams. Investors can choose between self-managing their properties or hiring a professional property management company. Self-management offers greater control, but requires significant time and expertise, while professional managers provide specialized services for a fee. Regardless of the approach, a clear understanding of operational best practices is essential for long-term success. Efficient management directly impacts NOI and property appreciation. It is an ongoing commitment to asset preservation. Tenant acquisition and retention. Successful tenant acquisition and retention are paramount for maintaining high occupancy rates and consistent income in a commercial property portfolio. Effective acquisition involves strategic marketing, competitive leasing terms, and thorough tenant screening to ensure reliable occupants. Marketing efforts should highlight property features, location advantages, and suitability for target businesses. Retention strategies focus on providing excellent tenant services, prompt maintenance, and fostering positive landlord-tenant relationships. Regular communication and addressing tenant needs proactively can significantly reduce turnover costs and vacancies. Offering lease renewal incentives and creating a desirable business environment also contribute to long-term tenant loyalty. High retention rates reduce operational expenses and provide stable cash flow. This proactive approach is a cornerstone of portfolio profitability. It ensures a steady stream of revenue. Lease agreements and structures. Understanding various lease agreements and their structures is fundamental to managing commercial properties effectively and protecting investor interests. Common lease types include gross leases, net leases, single, double, triple, and percentage leases, each with different allocations of operating expenses between landlord and tenant. A gross lease typically means the landlord pays all expenses, while a triple net NNN lease shifts most operating costs, including taxes, insurance, and maintenance, to the tenant. Percentage leases involve a base rent plus a percentage of the tenant's gross sales. Carefully drafting and negotiating lease terms, including rent escalations, renewal options, and tenant improvement allowances, is crucial. The choice of lease structure significantly impacts a property's net operating income and risk profile. Legal counsel is essential for ensuring robust and enforceable agreements. This knowledge empowers investors to optimize their income and manage liabilities. Maintenance and capital improvements. Strategic maintenance and capital improvements are vital for preserving property value, attracting quality tenants, and ensuring long-term portfolio profitability. Regular preventative maintenance, including HVAC servicing, roof inspections, and landscaping, minimizes costly emergency repairs and extends asset lifespans. Capital improvements, such as renovating common areas, upgrading building systems, or enhancing facades, can increase rental income and property appreciation. These investments should be carefully planned and budgeted, considering their potential return on investment and impact on tenant satisfaction. Balancing immediate needs with long-term strategic enhancements is key to optimizing property performance. A well-maintained property commands higher rents and experiences lower vacancy rates. This proactive approach ensures the portfolio remains competitive and valuable. It is an ongoing commitment to asset quality. Risk management in property portfolios. Implementing robust risk management strategies is essential for protecting a commercial property portfolio from unforeseen challenges and financial losses. This involves identifying, assessing, and mitigating various risks, including market downturns, tenant defaults, property damage, and legal liabilities. Diversification across property types and locations is a primary risk mitigation tool, spreading exposure. Thorough tenant screening and strong lease agreements reduce the risk of income loss from defaults. Comprehensive insurance coverage protects against physical damage and liability claims. Regular property inspections and maintenance prevent costly structural issues. Developing contingency plans for economic fluctuations and market changes further strengthens portfolio resilience. Proactive risk management safeguards capital and ensures long-term stability. It is an ongoing process of vigilance and adaptation. This strategic approach minimizes potential negative impacts. Insurance for commercial properties. Securing adequate insurance coverage is a fundamental component of risk management for commercial property portfolios. Various types of insurance protect against a wide array of perils and liabilities. Property insurance covers physical damage to the building and its contents from events like fire, storms, and vandalism. Liability insurance protects against claims arising from injuries or property damage occurring on the premises. Business interruption insurance provides income replacement if a property becomes temporarily unusable due to a covered loss. Flood and earthquake insurance may be necessary depending on the property's location and specific risks. Carefully reviewing policy terms, coverage limits, and deductibles is crucial to ensure comprehensive protection. An insurance broker specializing in commercial real estate can help tailor policies to specific portfolio needs. This essential protection safeguards your investment against unforeseen events. It provides financial security and peace of mind. Exit strategies and portfolio optimization. Developing clear exit strategies and continuously optimizing your portfolio are crucial for realizing profits and adapting to market changes. An exit strategy outlines how and when you plan to sell a property or the entire portfolio, whether it's through individual asset sales, a portfolio sale, or even a 1031 exchange for tax deferral. Portfolio optimization involves regularly reviewing each property's performance, identifying underperforming assets, and rebalancing the portfolio to align with current market conditions and investment goals. This might include selling mature assets to reinvest in higher growth opportunities or divesting properties that no longer fit the portfolio's strategic direction. Strategic timing for sales can significantly impact returns. Proactive optimization ensures the portfolio remains dynamic and profitable. It is a continuous process of refinement and strategic adjustment. Valuation methods for commercial assets. Accurately valuing commercial assets is essential for making informed acquisition and disposition decisions within a portfolio. Several valuation methods are commonly employed, each offering a different perspective on a property's worth. The income capitalization approach, often using the cap rate, estimates value based on the property's net operating income. The sales comparable approach analyzes recent sales of similar properties in the area to determine a market value. The cost approach estimates value by calculating the cost to replace the property new, less depreciation. For small commercial properties, a blend of these methods often provides the most accurate valuation. Understanding these methods allows investors to assess fair market value and negotiate effectively. Proper valuation prevents overpaying and ensures profitable sales. It is a critical skill for any investor. Tax implications of property ownership. Understanding the tax implications of commercial property ownership is crucial for optimizing returns and minimizing liabilities. Investors should be aware of property taxes, income taxes on rental revenue, capital gains taxes upon sale, and potential depreciation deductions. Property taxes are typically assessed annually by local authorities and vary significantly by location. Rental income is generally subject to ordinary income tax rates, though operating expenses can be deducted. Depreciation allows investors to deduct a portion of the property's value over its useful life, reducing taxable income. Capital gains taxes apply to profits from property sales, but strategies like 131 exchanges can defer these taxes. Consulting with a qualified tax professional is essential to navigate these complexities and implement tax-efficient strategies. Proper tax planning can significantly enhance net profitability. It is a vital aspect of financial management. Building a professional network. Cultivating a strong professional network is invaluable for success in building a commercial property portfolio. This network includes commercial real estate brokers, lenders, attorneys, accountants, property managers, and other investors. Networking provides access to off-market deals, expert advice, financing opportunities, and potential partnerships. Attending industry events, joining professional associations, and actively engaging with peers are effective ways to expand your network. Strong relationships can lead to referrals, shared insights, and collaborative ventures that might otherwise be inaccessible. A robust network acts as an extended team, offering support and resources throughout the investment journey. It accelerates learning and helps overcome challenges. This collaborative approach is a powerful asset for any investor. It opens doors to new opportunities and knowledge. Scalability and growth strategies. Developing effective scalability and growth strategies is crucial for expanding a small commercial property portfolio into a substantial asset base. Scalability involves implementing systems and processes that can handle an increasing number of properties without a proportional increase in resources. This includes leveraging technology for property management, standardizing acquisition procedures, and building a reliable team. Growth strategies might involve reinvesting profits into new acquisitions, utilizing 1031 exchanges to defer capital gains, or exploring joint ventures for larger projects. Focusing on specific market niches where expertise can be replicated also facilitates growth. Planning for growth from the outset ensures that the portfolio can expand efficiently and sustainably. It transforms a collection of properties into a robust, growing enterprise. This foresight is key to long-term wealth creation. Case studies. Successful portfolios. Examining case studies of successful commercial property portfolios provides invaluable real-world insights and practical lessons for aspiring investors. These studies highlight diverse strategies, market conditions, and management approaches that led to significant wealth creation. Analyzing how successful investors identified opportunities, mitigated risks, and navigated challenges offers actionable takeaways. Case studies often reveal the importance of long-term vision, adaptability, and continuous learning in the commercial real estate sector. They demonstrate that success is not always about large initial capital, but often about strategic decisions and diligent execution. Understanding these narratives can inspire and inform your own portfolio building journey. They offer concrete examples of what works and why. This practical application of knowledge is highly beneficial. Future trends in commercial real estate. Staying abreast of future trends in commercial real estate is essential for adapting investment strategies and maintaining a competitive edge. Emerging trends include the increasing demand for flexible office spaces and co-working environments, driven by evolving work models. E-commerce growth continues to fuel demand for logistics and industrial properties, particularly last-mile distribution centers. Sustainability and green building practices are becoming increasingly important, influencing property design, construction, and tenant preferences. Technological advancements, such as smart building systems and data analytics, are transforming property management and operational efficiency. Demographic shifts and urbanization patterns also play a significant role in shaping future market demands. Proactive investors will integrate these trends into their portfolio planning. This forward-thinking approach ensures long-term relevance and profitability. It positions the portfolio for future success.